Gold has long been considered a valuable asset, and its allure has only grown with time. It is an exceptionally liquid asset, free from liabilities and credit risk, and it remains scarce, historically maintaining its value over time. Additionally, gold benefits from diverse demand sources as an investment, a reserve asset, jewelry, and a component in technology. And these qualities enable gold to enhance a portfolio in three key ways: returns, liquidity, and diversification. And that's what we're looking at today. Returns, liquidity, and diversification. Understanding these aspects will help you to make informed decisions about how to invest in gold alongside the likes of stocks and bonds in your diversified portfolio. Now, gold has a historical track record of providing substantial returns, especially during periods of economic uncertainty. And unlike stocks or bonds, which can fluctuate wildly in response to market conditions, gold has shown a tendency to maintain its value and even appreciate during turbulent times. This characteristic stems from its status as a safe haven asset. And when markets are volatile and investors lose confidence in fiat currencies and other traditional investments, they often turn to gold. But you don't just have to wait for uncertain times for gold to deliver. As you can see on this chart from the World Gold Council, it has generated long-term positive returns in both good and bad economic times, despite the performance of risk assets. Much of this is thanks to the diverse sources of demand. In the last 10 years, gold demand has been split as follows: 35% from jewelry demand, 7% from technology, 39% from investment, and 9% from central banks. And it is thanks to this diversity that we see less volatility when compared to other asset classes. Gold also performs well both against inflation and deflation. Since 1971, it has outpaced both the US and global consumer price indices, serving as a safeguard against high inflation. And when inflation ranged between 2 and 5%, gold's price rose by an average of 8% per year. And as you can see in this chart, this increase became even more pronounced with higher inflation levels. Consequently, over the long term, gold has not only preserved capital, but also facilitated its growth. Moreover, gold's finite supply contributes to its potential for returns. And unlike fiat currencies, which can be printed in unlimited quantities, gold is a limited resource and has significantly outperformed all major currencies since 1971. A key factor behind this strong performance is the slow growth of gold mine production, which has roughly increased by roughly 1.7% per year over the past 20 years. Its extraction is becoming increasingly challenging over time, and this is making it scarcer and potentially more valuable. Now, of course, what hasn't been restricted in any of its production? Fiat currency. But don't worry, because there's a hedge here, and it is, of course, gold. You can see just how closely gold has tracked the rapidly increasing US money supply. This, combined with low interest rates, fostered a perfect environment for the gold price to gain ground. However, it's important to recognize that gold is not immune to price volatility. Short-term fluctuations can occur due to various factors, including changes in interest rates, geopolitical tensions, and shifts in investor sentiment. But do not be disheartened. As assets go, gold is one of the least volatile. Therefore, while gold can offer significant returns, it is crucial for investors to adopt a long-term perspective. Do not be swayed by short-term market movements. Now, let's think about number 2 on this list: diversification. Diversification is a fundamental principle of portfolio management, and this is aimed at reducing risk by spreading investments across various assets. And gold's unique properties make it an excellent tool for diversification, as it often behaves differently from traditional financial assets like stocks and bonds. One of the key benefits of gold is its low correlation with other asset classes. Now, while stocks and bonds may be influenced by economic cycles, interest rates, and corporate earnings, gold's price movements are driven by different factors, such as geopolitical events, currency fluctuations, and supply-demand factors. This low correlation means that gold can provide a counterbalance to the volatility of other investments. Now, during periods of market stress and systemic risk, gold has historically acted as a safe haven, preserving capital when other assets are losing value. And the global financial crisis served as a brilliant example of this. Equities and other risk assets plummeted in value, along with hedge funds, real estate, most commodities, which were previously considered portfolio diversifiers. And in contrast, gold maintains its value and even increased in price, rising by 21% in US dollars from December 2007 to February 2009. And similarly, during the sharp equity pullbacks between 2020 and 2022, gold's performance remained positive. And diversifying with gold also allows investors to tap into the metal's long-term growth potential. And while short-term price movements can be unpredictable, as we said, gold has demonstrated a steady upward trajectory over the long term. And by including gold in your diversified portfolio, you can benefit from its appreciation whilst mitigating risks that are associated with those other asset classes we discussed. Now, this protection offered by gold doesn't just come from when the proverbial hits the fan, as this chart shows. Gold also performs well in the recovery periods following a systemic sell-off. It delivers positive correlation with equities and other risk assets in positive markets, making gold a well-rounded hedge. And once again, this is largely thanks to its role as both an investment and as a consumer good. Now, liquidity is another crucial factor that makes gold an attractive addition to your diversified portfolio. And interestingly, people don't expect a tangible asset like gold to be particularly liquid market. But when you store gold in allocated, segregated storage locations, as offered by GoldCore, then you have access to one of the most liquid markets in the world. Liquidity refers to the ease with which an asset can be bought or sold without significantly affecting its price. And as I said, gold is one of the most liquid assets available, providing investors with the flexibility to enter or exit positions with relative ease. The global gold market is vast, it's well established, and with a robust infrastructure that facilitates trading. And gold can be traded in various forms, including physical bullion, such as bars and coins, ETFs, futures contracts, and mining stocks. But physical gold, such as bars and coins, is a highly liquid market and can be easily sold using well-established companies such as GoldCore. Holding gold this way gives you all the benefits of owning gold compared to the other options, which are mainly about price exposure rather than using it as an insurance in your portfolio. The liquidity of gold ensures that investors can quickly convert their holdings into cash, making it an ideal asset for managing unforeseen financial needs or rebalancing your portfolio. And this attribute is particularly valuable during market downturns or economic crises when other assets may become illiquid or lose value rapidly. Now, if you want to find out more about how to add gold to your portfolio, then why not click on one of these links here or get in touch with us today.